Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and it is October 9th. We are live. It's October 9th, 2024, I should add, just so everyone knows the year that we're in. We're going live as we do nowadays on our podcast. And it's going to be great because we've got a great guest coming back to the show, David Keller, who has been on a number of times. But David, you're coming on with a new title now. So you're the CEO, president, head honcho, and chief market strategist of Sierra Alpha. So this is a new venture that you're doing. So welcome back to the show.
Thanks, Justin. I like all those titles. I might incorporate all of them for sure. But no, it's good to be back with you. I've always enjoyed talking with you and others at the in the world of IBD. So pleasure to be back.
Yeah, and we've had David on as a guest on IBD Live. So for those of you that have checked out IBD Live before, he's a great guest. Goes through so much technical analysis. As we often note when David is on, he has those special three letters, the CMT designation, which just means that he's really done some study on the technical analysis side. And of course, your background, Fidelity Chart Room. I mean, that's one of the legends, right?
It's a really cool space dedicated to market history and investor psychology. And when I think about Bill O'Neill and his legacy, it's as a market historian. I mentioned before, I have the Bill O'Neill mouse pads somewhere in my office here that I've used for years and years.
Okay.
And I love just these like classic charts with notes and using the charts as a conversation you're having about these stocks and these markets. So I mean, O'Neill did an incredible job of really documenting historical successful charts and what makes a good company and a good investment. And the chart room, we were really trying to do that for our mutual funds and trying to help learn the lessons of market history, which I think even again today, so many people could stand to learn a little bit about market history. Hopefully, we'll do a little bit of that today.
Yeah, absolutely. And of course, one of the reasons why sometimes people shy away from that whole idea of the history is, they kind of, well, things are different now. We're special. We don't make the mistakes that people made back then, or things are much faster. Our technology is better. We're smarter. All of those things. Do you find that to be the case necessarily?
Not at all. I mean, I get the argument. I totally get the argument, Justin, and you're right. I think the reality is human nature is pretty consistent. And I think if you look around you, people, I mean, even with all the tools we have, the devices we have, the connectivity we have, people still get super excited, super desperate, super nervous, super euphoric when conditions around them cause them to do so. And so I still see investors buying too early, buying too late, selling too early, selling too late, sort of those four cardinal sins. It still happens even with all the tools we have available. So I would argue, even though we have access to essentially unlimited information and incredible capabilities with AI and all the promise, we're still humans making human errors. And so I think, surrounding yourselves with resources and tools to help you minimize the impact of those negative decisions and just better understand the market environment, I think are more valuable in 2024 than ever before.
Yeah, and I think that's why a lot of us really like to lean on the technical analysis part of things, because especially I'm just gonna say it. There's a lot of turmoil out there, right? I mean, the headlines. If you just read the paper, I feel like I would just want to be in a bunker and go in there with my canned goods. And the thought of sticking your neck out with investments would be a little distasteful. Certainly right now we've got hurricanes. We just celebrated a 1 year from the Hamas-Israeli conflict. We've got the election coming up, and let's not forget that even before the election, we've got another earnings season coming upon us very shortly. That's always fraught with peril as you kind of decide, wow, is it going to be one of those things where stocks react favorably, or is it, the CFO coughs wrong and the stock tanks 10%? So again, how do you kind of manage your emotions when, again, you're seeing all these headlines that kind of can shift things?
And talk about a sign of the times, Justin. You mentioned all of those very real, very market moving macro themes. We didn't even talk about the Fed rate cut cycle, inflation. Like that's just down the list of this, this growing list of concerns. And I mean, and to your point, I think if you focus too much on each of those items and what they could do, you'll go crazy thinking about all of these different possibilities. That's what I love about using charts and technical analysis consistently, is the whole point of it is the markets arguably are the best way to aggregate what everyone is thinking and worried about and
Mhm.
concerned about and confident about. Price is a great reflection of that, because more buyers than sellers, more sellers than buyers, all makes the price move. And so when investors get jittery or investors get really excited, the price tells you that very, very quickly. So I would encourage people to, the way that you look less subjectively and more objectively at the market dynamics is focus on trends, clearly define what you're seeing, and have an exit strategy, and then stop worrying about it, right? Think about, all right,
Mhm.
this is the trend I see. If I see XYZ happen, that tells me it's something different. And until I see that, I'm going to just sort of follow what this is going. And trends continue to persist here in October of 2024. I think they'll keep persisting for quite some time.
Yeah. Well, let's you mentioned charts and how useful they are, so let's get to some. I'm going to go ahead and start with the Nasdaq Composite,
Yeah,
which is a lot of times where we've tended to start, but this has actually been kind of lagging. This is our relative strength line versus the S&P 500, and
yeah,
it did perk up a little bit here in September, but really since July, this has been in a downtrend. The Nasdaq just hasn't been holding up nearly as well as the S&P 500.
yeah,
The S&P 500 kind of met a lot of milestones before the Nasdaq did. It got to new high territory first. It crossed levels of resistance first. So do you think it's kind of the Nasdaq's time to shine? It's had its time in the corner thinking about what it's done, and it's time for it to get out of its time out.
ready to come out of the penalty box and join the class. I mean, perhaps, right. And I think when you look back at 2024, there have been a couple clear leadership regimes that we've observed, right? Sort of Q1 was the Magnificent Seven dominating, right? The mega cap growth trade, sort of dwarfing everything else. Then later into the spring, we got into more value sectors, right? Like industrials, materials, all of a sudden starting to look very good. Then in the third quarter, you had sort of a market pullback. That's where the Nasdaq's coming off. And all of a sudden, defensive sectors, which have been sleeping for most of the year, all of a sudden all wake up, and REITs and consumer staples, Colgate, Palmolive kind of stocks are all of a sudden looking pretty good. Now, I think it's a very open question in terms of what that next leadership theme is going to be. And I think a lot of that, to be honest with you, I think what will end up working is going to be a lot driven by elections, a lot driven by interest rates, a lot driven by some themes that I think we'll get more clarity on in the next month or so. But I am super encouraged by the improvement I'm seeing, particularly in technology. And it's leading names like a Palantir, right? Just kind of in these nice sort of steady uptrends.
Mhm.
But it's kind of the other things, right? It's semiconductors, it's AMD and Nvidia that had been in a very consolidating kind of sideways pattern, and now we're all starting to feel like they're resolving to the upside. So I'm certainly seeing a lot to be impressed with technology, and not just a name or two. I think more broadly speaking, you're starting to see that. So the performance gap, I would argue, between the S&P and the Nasdaq maybe starts to narrow a little bit here, certainly as we go on in the coming weeks.
Yeah. To your point, heading back over to the NASDAQ, I think an important kind of shift, as you were saying, with that third quarter was on July 11th. Of course, this was a
Mm,
CPI day. And as bad as the NASDAQ looked on that day, to your point, like the Russell 2000 on that day was skyrocketing, right? And
yeah,
it was short lived, granted. The Russell 2000 gave you all of 2.5 weeks to participate in that move before it just tanked.
yeah,
But it's again that those very quick rotations, and it's worth mentioning. Tomorrow we have a CPI report. I feel like n- people aren't as on edge, like, oh, I can't do anything because the CPI report is up or the PCE report is up, or pick your inflation gauge of choice. But with that 50 basis point cut now kind of starting the ball rolling, saying inflation is not as big a concern as the recession,
yeah.
labor market, and all of those things. Do you think the CPI report holds the same level of import?
Yeah, worrying about inflation is so May, June of 2024, isn't it? It's old news. I mean, to be honest with you, I think, the Fed has certainly communicated, Powell and others have communicated that, sort of inflation is sort of doing what you'd want it to, according to how they're, they've approached it, and the levers that they pulled have sort of, slowed things down to a degree that it's sort of doing what you'd expect. And now they're focusing more on job creation and making
Mhm.
sure that jobs remain robust. I would argue that that's all fine and good, but a big change outside of the expectations of inflation, I think, still has the opportunity to shock the markets in the short term, for sure. Only because I think at this point, again, with all the things going on around us in the world, the Fed's rate cut cycle, I still think, is a hugely important theme going into the beginning of next year. And once we get through election season, and once we get through hurricane season, hopefully, and get through that, this will still be a very real market moving scenario. And I think different types of stocks. I mean, the reason why defensive stocks are so attractive is because rates come down so quickly. And if that starts to change, all of a sudden utilities aren't as good of a bet as they were before. And so I think a lot of the leadership themes have been tied to interest rates and all of that. So I still think it's super important to watch the inflation data. What they've said certainly is jobs are more important as well. At the end of the day, I think the markets are what's most important to follow. So let's see how we trade going into it, but especially react to the numbers that are released. I think
Mhm.
that's key.
Yeah. And, before we get to the S&P 500, and I do promise we're getting there, I just want to kind of show the 10-year Treasury yield,
Mm,
because certainly I mean, it was already kind of starting to move up. We did see, especially with the Fed funds futures,
mm,
a big change in the expectations of, okay, we're looking at maybe another 50 basis point cut in November. And then the jobs report came out last Friday, and it was like, whoop, no, we're going the other way. It's, 25 is still really on the table, but
yeah,
50 is base. It was a 0% chance of no cut to now a 0% chance of a 50 basis cut, and a likelihood that there might be no cut.
yeah.
So the 10-year Treasury yield back above 4%. Normally, that's something that you would think that kind of move would, really have an effect on markets, but I guess, what is it? The lack of recession fears subsiding, um, what's your take?
I mean, I think you're right, and I would say, with things like the 10-year yield, I think a lot of people probably spend too much time trying to pinpoint inflection points, and arguably, more broadly speaking, with stocks, with things like the S&P, or with a key name, we spend so much time and energy trying to think about, was that the peak, was that the buy, trying to pinpoint a
Mhm.
particular move. And people that claim to have done so are super proud of, I called the top or I called the bottom. I would argue the game for most people is less about predicting a top or bottom to the day. It's recognizing when the trends have changed, and I think
Yeah.
that's where a lot of investors are on the wrong side of things and then stay on the wrong side of things. Right, recognizing that rates have gone down with the 10-year yield from 5% down to 3.75%. Huge change, right? And so ignoring the fact that rates were in an uptrend and now are very much not in an uptrend, I think that's the problem. That's what you want to avoid. You want to avoid missing the change in trajectory. And so I think
Mhm.
the risk right now is that rates continue to go higher. I think a lot of groups like home builders, for example, all of a sudden seem like really decent bets because rates are coming down and things are becoming a lot less expensive. I think that's a really good bet. If rates continue to go much higher than this, though, I mean, is that really still the thesis anymore? And too often we sort of develop our thesis. It's called a narrative bias. You develop a narrative, and then kind of that's your trade. And even if everything changes around you, you kind of still stick with that trade,
Yeah.
regardless of the fact that the evidence is no longer supporting it. So recognizing inflection points in some of these areas and just recognizing when the trends have shifted, I think is super, super valuable. And I'm certainly watching the 10-year with that in mind.
Mhm. Or, even worse, sometimes you do see the evidence that maybe your thesis is wrong, and you just ignore it, because
Ignore it, right?
I'll just keep on looking at the evidence that says that I'm right, because that just makes me feel better as a human being. But
Yeah,
uh,
yeah,
let's go ahead and go over to the S&P 500.
yep.
And as you mentioned, there were certainly a lot of areas where, when the Magnificent Seven kind of took a break, when tech was kind of taking a break, you had the utilities, the industrials, the financials. You had all these other areas that were, they might not have been making the same types of moves that you would expect out of tech, but they were going up. And so
Mm.
the S&P 500 has been, looking really strong here, and all-time highs today, looking like it just kind of came out of this little thing. I mean, it got support right here, exactly where you'd want it, at the top
Yeah.
of this previous base, or these previous areas of resistance.
Yep.
Didn't even come down. This is the green line is our 21-day exponential moving average line. Didn't even come down to that, and right back to all-time highs. It just doesn't want to go down.
It certainly seems the case, right? And from a technical perspective, I'd call that a pivot point, which is
Hmm.
a level of resistance that then becomes support, and that is a well-trodden, path within technical analysis. Happens so often, and with individual stocks, you see that all the time, right? Like a big basing pattern. You break out, you test the breakout level, and then continue up. That's around 5650 on the S&P 500. For me, that's a really good kind of line in the sand. We mentioned earlier, how do you sort of stay sane with what's happening in the market at any given time? I do. It's called the line in the sand approach. At least that's what I call it, which is,
Hmm.
define the trend. The trend in the S&P is up, right? We're making higher highs and higher lows. We're above upward sloping moving averages. That's all pretty constructive. We're above a trend line using the major lows in August and September. That's all pretty constructive. So what would you need to see to start to question the fact that this trend is clearly going up? And for me, 5650 is a pretty decent starting point. It's pretty early, right? I mean, it wouldn't take long. That's a big down day for us to get below there, to be honest with you. But the other side of that is, as long as we remain above 5650, how concerned do I want to be about market downside? The answer is not a whole lot. I think you want to think of it like you're programming in Excel, and think of it like an if-then statement. If we break 5650, then we have the possibility to do these other things. But I think a lot of times people all of a sudden are thinking too much about downside targets that are nowhere near really probable at this point. I'm happy assuming that the trend is innocent until proven guilty. 5650 is kind of that breakout level where I think you start to question it, and at the very least start to think about money management and make sure you have stops that are updated, and make sure you're limiting your losses. That's how you survive to invest for the next cycle.
Hmm. Any kind of final thoughts on the market in general before we kind of get into our next segment?
I mean, I think to be honest with you, the only other space we haven't really talked about, sort of precious metals and
Mm,
commodities. I mean, obviously, there's a lot of noise in crude oil related to events in the Middle East, understandably
right.
so. But I think when you look, we talked about the Nasdaq, we talked about the S&P. Hold the phone, because gold has outperformed both of those year to date, right? And by a decent amount. So I think gold feels very overextended when you look at the trend over time, and you're seeing a bit of a pullback in gold and silver prices this week. But again, similar to what you saw with the S&P, as long as we keep making a pattern of higher highs and higher lows, as long as we remain above trendline support, as long as we remain above key moving averages, I think the charts are pretty strong. And for now, I would argue gold is still sort of in a primary uptrend, but I'm
Mhm,
acutely aware of what levels I would need to reconsider something like the GLD or the GDX here.
mhm. Well, since you opened the can of worms, now we have to. I have to ask a follow up, because
Oh yeah, do it.
you brought up so many commodities. It's worth bringing up the strength of the dollar. So this is UUP that tracks the dollar, and you're
Yeah.
seeing kind of a surge here. Of course, that has a negative correlation. It often puts pressure on commodity prices. So, um, you know, what are your thoughts on the strength of the dollar and how that affects other things?
Yeah. And so as this trade in gold has continued to work, and I've shared a number of times over the year, I've shared a chart just looking at the performance, year to date performance of the GLD, the SPY, the QQQ. And pretty much anytime I've done it, gold's been at the top of that list. I mean, consistently through a lot of these
Uh-huh.
different cycles. And it was more just a, did you know, like, are you recognizing
Right.
the strength that you're seeing? It's a reminder that regardless of what we think should be working, right? Gold's a safe haven. It shouldn't be doing well. It is. Now, when I've been asked, well, what's the risk to that? It's the dollar, right? Because the dollar has been in such a good, consistent downtrend for so long. That sort of provides this boost to gold prices, because the dollar's a big sort of that's the opposite trend. So the spike in the dollar has been a part of that immediate pullback in gold. So I think the biggest risk to the precious metals charts looking as strong as they have year to date is a rally in the dollar, and that you've started to see the beginning of that. I think the dollar continues to go further, and certainly the dollar seemed to have bounced off of a key support level right around 100, for the dollar index, sort of bounced off from there. And if the dollar really continues to strengthen in a more meaningful way, that's when I think you need to think about, all right, what does that mean for multinational companies that have a lot
Right.
of their revenues outside the US and have to at some point convert them back to US dollars? It's not sort of in the danger zone of that, but that's what I think you start to think when you have an equity portfolio, and just thinking about where a strong dollar regime could change the thesis that's worked maybe in some cases for some of those charts.
Yeah, it definitely gets interesting during earnings season because you start hearing the complaints about, well, it's not fair because the strong dollar, is what
Yeah,
caused all of these our numbers to not look so good
that's
and
right.
stuff,
That's right.
especially with those multinationals. So okay, let's go ahead and shift gears a little bit and talk, because you mentioned it earlier. A lot of times people want to be on the hill saying, look, I'm the one that kind of called it right at the top, and they're looking at all these different indicators to
Yeah.
suggest, oh, things are getting tired, or I mean, there's a whole host of technical indicators, sentiment indicators. Are there any that you gravitate towards to kind of tell you, not necessarily that you're at the top, but hey, it's a caution flag. It's something to be aware of, that we're in an environment that you
Yeah.
might want to start looking at locking in some gains, or at least being on ready to go on defense.
Yeah, for sure. So I think of my role. I mean, I consider myself a trend follower primarily. So my goal is threefold any given day. One is identify trends.
Hmm.
Second is to follow those trends and assume that they will persist and make sure that I'm following the continuation of that trend. And then the third one, which is what you're alluding to, is anticipating when that trend might be over. And this is
Hmm.
the part of the technical toolkit that I would argue is more of a leading indicator, a set of leading indicators. A lot of the technical analysis toolkit is very much a trend following approach, right? I'm looking for moving averages that are sloping upwards. I'm looking for relative strength to start improving. And all of those tend to happen after the price has already started to make progress. But there's also parts of the technical toolkit looking at divergences, looking at weakness in some metric that would tell you that even though the price is looking good, underneath the hood of the market, right, or looking at the details behind there, you start to see a disagreement. And those disagreements often have a great predictive value, because before the price tops, I mean, as the price is still going up, the conditions start to deteriorate. And
Hmm.
it happens pretty common. And market breadth indicators are the best way I know to think about it, because especially at major market tops, when the in the later stages of that bull market phase, a lot of things actually are no longer going up. They're no longer driving higher, but the indexes keep going up because of the biggest, in a lot of ways, more defensive kind of blue chip names are strong enough to propel the index higher, even though a lot of names rotate lower. So a lot of measures of market breadth are really designed to help you recognize when that disagreement is starting to come out. And arguably, we're maybe starting to see that here in 2024.
Hmm. Okay, well, let's maybe start a little bit more historically.
Yeah,
You brought some charts. These are from stockcharts.com with some of these indicators that you have in terms of whether it's the looking at the percentage of stocks above their 50-day moving average lines, and so on. But yeah, let's go ahead and start with our first chart, and this goes back to 2007.
yeah,
Of course, in 2007, as frothy as it was, no one was thinking, oh, we're probably looking at a great financial crisis next year where everything is going to grind to a halt. It's never, you never know how bad things can get. You just kind of know, oh, things are starting to turn possibly. So kind of explain, we got the price on the top here
yeah.
in this chart, and then you've got a few different things that you're looking at below. So can you describe those for us?
Yeah, so I'm looking at the 2007 market top really as more of a case study in what a major peak kind of looks like. And to your point, right? I mean, at that peak, which I've shaded in a purple shading area there at the top. I mean, at the top, it's really hard to recognize that that's a top, right? In the rear view mirror, it seems really obvious that
Mhm.
okay, a lot of frothiness was happening, and as things unwind, you recognize the forces that were at work there. But at the time, the market was going up. So we basically have the S&P 500 at the top, looking at that period going into and then coming out of that 2007 peak. And then we have three indicators top to bottom below there. The first one's called the McClellan oscillator. And this is a way of analyzing advanced decline data, right? On an average
Okay.
day, you have the advancers, decliners, how many stocks are up, how many stocks are down. Tom McClellan's parents, Sherman and Marion McClellan, decades ago, came up with this oscillator, kind of turning it into a momentum indicator measuring the changes in breadth conditions. If it's above zero, it's bullish. If it's below zero, it's bearish. And that is a very simple way of thinking of that measure of breadth. The next panel down is looking at, well, what am I looking at there? Oh, percent of stocks above their 50-day moving average. So this is, while the S&P is above its 50-day moving average, and I think that's an encouraging sign, you look at all 500 stocks in the S&P, how many of them can stay the same? And when that gets above 70%, we're in a kind of a euphoric level. When we come out of that 70% level, it can tell you that things are maybe starting to change. And then in the bottom, in the green and red histogram there, that's showing you every day the new 52-week highs and the new 52-week lows. So it's literally counting how many stocks are breaking out, how many stocks are breaking down on any given day. So if you look at the performance going into that purple shaded area, which again ended up being the 2000 market top, what were the breadth conditions going into there? We had the McClellan oscillator above zero, and it remained above zero for quite some time, right? 4 or 5 weeks, just showing you that the short-term breadth was very strong. The advanced decline data was improving. We had all of a sudden over 70% of the S&P 500 members above their 50-day moving average, which means kind of almost everything is in a primary uptrend at that point. And you have a bunch of new 52-week highs, meaning those leading names are kind of getting it done. And you have very few stocks making new 52-week lows. Look at how that changed as we get toward the end of that purple shaded area for the S&P 500. You can see everything I just said was no longer the case. So the McClellan oscillator breaks below zero, which tells you the short-term breadth is starting to change to more bearish advance or decline data. Stocks are trading lower on an average day. Instead of over 70% of stocks above their 50-day, we have less. We have 60, we have 50, we have even 40. So a lot of individual names are breaking well below their 50-day moving average, even though the S&P is still above it. Then finally, we have less and less stocks making new 52-week highs. So the green histogram is sloping downwards. So that suggests that those leading names that have been driving the S&P up, there are less and less that can say that, right? There are less and less that are going higher. So without looking at a bunch of, hundreds of individual charts of stocks, you can see from the breadth data that the breadth conditions were slowing down, that stocks were breaking their 50-day or their 10-week moving average, and that the new 52-week highs were becoming less and less. And you can see what happened in the months after that is everything just started to get worse and worse. You had a bunch of stocks making new 52-week lows. And so recognizing when the market is making a peak, I immediately glance down on a chart like this and just see, is the breadth data supporting it? And then when am I seeing the breadth data no longer supporting that uptrend? And often that can be a major top. And that's how 2007 actually, the reasons for it came clear later. But I think the technical reasons using market breadth were pretty clear, actually.
Yeah. Well, you know what? It's interesting that you mentioned that because I remember that time period. It was I'll be honest, 2007 was not a great year for me. It was a lot of slop until August, and
Yeah.
September and October were phenomenal. Like all the money was made there. And you know what? If it's okay, I'm going to change charts real quick. I did a change date to that time period, and it's interesting because a lot of those areas that you mentioned, where it started to break down, it was right in the middle of October, where you started getting the McClellan oscillator. And I remember this day right here on October 11th, 2007, a big downside reversal. It was like, oh, okay, this might be the warning sign.
Yeah.
And I'll be honest, what happened to me though is, we kind of went sideways for a little bit, and then I remember this vividly, Halloween, it was, oh, we're breaking out into new highs. We had gotten all this distribution. We broke out to new highs, and it was like, oh, maybe this is okay. And it was kind of like, I got to get back in. And then, exactly as you mentioned, it was, things really started breaking down in a big way, very quickly. I mean, I remember this day, November. Yeah, I thought it was November 4th, but yeah, maybe it was the 8th or something. I mean, I had VMware and, the IPO VMware, and, I think Crocs, was one of the big winners at that time. It had this, horrible earnings reaction on the 1st of November. And it was just, November, there was just nothing good could
Yeah.
happen. It was
Yeah.
everything was breaking down. So really interesting that again, those breadth indicators kind of got you in that environment. And the S&P 500 was not as ugly looking as the Nasdaq, but it certainly um, it certainly had some issues and very
And it's
quickly.
worth noting there, by the way, that that end of October on Halloween, the Nasdaq was making a new high, but the S&P actually was not. That was actually a really interesting
Mhm.
non-confirmation, which with one of the benchmarks breaking out, the other one actually made a lower. The S&P made a lower peak
Yes.
in at the end of October. Yeah.
Right. Yeah. So a really good example here. So let's go ahead and go back to your charts
Yeah.
real quick, and you've got another example to kind of show us. So
Yeah, so
uh,
yeah, the next one that comes to mind would be the 2020 peak, and before you go, telling your friends Dave is claiming he predicted COVID with charts. That's not what I'm claiming here. But what I am
uh,
claiming is that what ended up being the peak, the deterioration had already started to happen. And
yeah.
again, what the lesson here is the breadth divergence, right? The breadth indicators breaking down often happens as we're making a new high, which is why it's so counterintuitive. So if you're
Mhm.
not paying attention to sort of the metrics underneath the market, you see the S&P of the Nasdaq making a new all-time high. You think this is awesome. New highs are good. One of my mentors, Greg Morris, used to tell me all new highs are bullish except the last one. And so I think using tools like this to recognize, okay, new high, that's great. I immediately glance down and say, all right, are more and more stocks really participating? And what happened at the 2020 market peak? And again, a lot happened after the shaded area where COVID became a reality, and we all
Right.
sort of struggled with it. But the breadth conditions had really started to deteriorate, right? So again, the McClellan oscillator breaks below zero, telling you the short-term breadth is getting weaker. You can see all of those breadth indicators are trending lower while the S&P is making a new high into the February peak, and particularly the new 52-week high. So even though the S&P made a new high in February, less stocks were making new 52-week highs during that period. So again, there's a cohort of leading names doing quite well. The next new high, less stocks are participating. And that divergence, not to jump to the punchline of what we're seeing now, that's one of the things that concerns me now in
Mhm.
October of 2024 is you're seeing that same trend where there are less and less new 52-week highs as we're starting to make new highs now, particularly in the last couple of weeks, kind of from mid-September now to early October. You're seeing the S&P break out. You're seeing the McClellan oscillator break below zero. We're seeing the percent of stocks above the 50-day. It's literally right at that level as we're doing the podcast here.
Mhm.
Yesterday was below, today slightly above it. It's right at that 70% threshold. And the stocks making new 52-week highs have been trending lower. So again, on this week as we're breaking out, less stocks are participating. So the breadth divergence is what concerns me in a market like we're seeing now. And again, what this little history lesson tells you is that's what a lot of market peaks have kind of looked like, that divergence. The saving grace, I would argue, is something we saw back in like January, February of this year, where breadth conditions were a little negative, but the Magnificent Seven stocks were so strong that despite the weaker breadth, the benchmarks were able to remain quite strong. And that is a brutal environment for stock pickers. It's a brutal environment for active money managers who are trying
Mhm.
to pick stocks outside of the Magnificent Seven. Because
Right.
if those are what's working and other things are not participating, it's really hard to outperform unless you just layer into those mega cap names. And I think that's the risk for the market here is a lot of stocks maybe start to not work, but the benchmarks remain strong enough that it's a really tough environment to outperform. That's a risk here for sure.
Yeah, and I mean, that's where a lot of the closet indexers come from. I mean, they're almost being, why stick your neck out? No one's gonna fire you for buying Microsoft or Apple, or it's, one of those things where it's kind of the safe bet versus, going out a limb, not having enough,
Yeah.
again, especially compared to the indexes. Well, and to that point, you mentioned how a lot of times in the past, this breadth indicator was kind of reflective of the fact that maybe some of the defensive names, the big defensive names, were what were kind of propping things up. But now, I mean, are Microsoft, Google, and Apple the defensive names now? I mean, it certainly seemed like it for a while there,
Yeah.
because especially as rates were going up so much, it was kind of like, well, these guys are sitting on all sorts of cash. Higher rates don't affect them because they don't need to borrow.
Yeah.
They're just in a position of strength. But is the Magnificent Seven defense now?
It's interesting because the Magnificent Seven names, not all of them. I mean, I'm ignoring Tesla when I say this group now. So this
Mhm.
group of mega cap leadership names show a
The
lot of the
$1 trillion
characters.
club.
Yes, right. They show a lot of the characteristics of mature companies, but a lot of the characteristics of growth, right? And when AI is one of your big growth engines, I mean, you're certainly more of a growthy name at this point. But again, I mean, these are more established companies that are sort of immune to market dislocation. I'm still going to use my iPhone, and I'm probably going to still buy another one when it's time, regardless of what's kind of happening overall. Whereas some of the more speculative emerging growth names probably have a little tougher go with things. So
Mhm.
I think they're a little bit of both. And if you ask, right, if you're concerned about the market going down here, where do you go? I traditionally would say defensive sectors, right? Utilities, which have been pretty decent recently, and tend to be good low volatility ways of making it through. But I mean, Meta, Apple, Nvidia. I mean, these are pretty stable companies that certainly are tied into emerging themes. The other thing to think about is more of as a long term, as a long term investor, and really thinking about what themes are emerging that are probably going to be successful years later, right? What things do we see ourselves? What products and stuff do we see ourselves using down the road quite a bit? Electric vehicles and the growth in that area of the market. I think undeniably the reality that we'll be experiencing AI and related technologies, blockchain technologies. I mean, I think over time those will be quite well. So those big, stable tech and communications names that will benefit from those themes working seem like a safe place to be.
Mhm. Well, and interesting enough, a lot of times we've been talking about, you mentioned the utilities, and
Mm,
this is again what you typically think of as the boring. Okay, this is what you give the widows and the orphans, so they can get their dividend and everything like that. But it kind of
yeah,
almost turned into this AI adjacent. I mean, one of the stocks I ended up selling today because Constellation Energy,
mm,
came in quite hard, but this was this beat Nvidia. I mean, I think it was the
yeah,
top. Between this and VST, Vistra, I think these were the top stocks in the S&P 500.
yeah.
Uh, they're utilities. What like how do you have a utility topping the? I mean, usually if that happens, it's because the S&P 500 has gone down and the utility didn't go down as much. You
That's
don't
exactly
typically
right.
get a utility being top of the S&P 500 when it's going to new highs. So again, is there something different going on? And again, people always love to say it's different this time, but is there something different going on?
I mean, and you're right. I think the traditional idea is thinking of utilities as sort of that low volatility defensive play because if the markets are going to go down, I mean, the reality of active managers, money managers, is you tend to do much better in bear markets because you can get in defensive things that will not go down
Right.
as much, and that's where you really earn your keep. You
Mhm.
cushion from a lot of downside. Utilities, in a lot of ways, if you covered up the ticker of CEG or something and asked someone to guess what it is, I guarantee they would not say a utility stock. They'd say
Right.
technology or like a biotech or some more growth area of the market. I read something and I forget who I can't credit where I saw this, but it was looking at the utility company earnings calls, sort of the multi utilities in like Q1 to Q2 to Q3, kind of going through the month, and the number of times crypto and the energy requirements of crypto mining, and it was like mentioned 0 times the first quarter, and then almost all of them it was mentioned the second time. So that
Mhm.
is certainly, I think, part of this is the energy requirements of crypto mining and other related
Well, and
technologies
AI too.
and
AI
AI as
chips.
well, right? I mean, they all require a
Yeah.
staggering amount of computing power. That all requires a lot of energy, and so all of
Mhm.
a sudden, utilities are a growth trade. What I love about it, and what I love about what's happened with utilities, the charts told you that these are good places to be, right? And I always tell people the reasons why something works are crystal clear in the rear view mirror. So you don't have to know why CEG is necessarily a great call. The chart tells you this is a good place to be, and it tells you it's outperforming. And so if you thought the markets were going to go up, so I definitely don't want to own gold and utilities in 2024, talk about the wrong call, right? Because
Yeah.
those are some of the strongest places. So for me, the lesson learned is focus less on what you think should happen, although that's an important thought process to go through. But don't forget the benefits of recognizing that the trends will tell you something that you'll learn the reality of much later, right? It'll make sense down the road when they
Yeah.
write a book about 2024, but don't miss an emerging trend just because it doesn't make sense to you at that particular time.
Yeah, that's so important. I mean, I feel like there have been so many cases where, I kind of joke. There was the show Early Edition. I don't know if you remember that,
Yeah.
where
Oh, yeah.
the guy gets, he gets the paper, and
Before it
he's
happens.
but,
Yeah.
but before, yeah, but
Yeah.
a day ahead of time, and there's a cat involved, and we never know what the cat's issue is, why the cat's there. But yeah, he gets the paper, and he does good with it. He's trying to, save people and everything like that. But I kind of think, you would think that with that information it would be invaluable, but I
Mm.
sometimes say, well, gosh, man, if you had given me the headline, I would have done the exact wrong thing. I mean, COVID,
Yeah.
when COVID
Yeah.
was happening, to your point, everything looked like it was falling apart. But yet in April, we kind of had a follow through day. And yes, in the rearview mirror, it's like, oh, well, obviously the stimulus and, everything that the Fed was doing and, how much they increased their balance sheet. Yeah,
Yeah.
obviously, when you have that much money sloshing around, but at the time, if you just looked at the headlines, no one was talking about, oh, look at what's going to happen a year from now in the market because of, what the Fed is doing. It was, oh my gosh, the sky is falling. So yeah, very
Yeah,
good point.
in my institutional days, we would call that you got the market call right, but you didn't get paid for it. And
Mhm.
it was like your gravestone as an analyst would be, got the call right. And it's like what does that really get you, right? Because you're paid to outperform. You're paid to own things that are doing better than other things. And so
Yeah,
getting the call right, getting the idea, recognizing a theme that's emerging like that feels good,
yeah,
but you get paid by owning things that benefit from that. And a lot of times that can be very difficult to gauge at the beginning. But again, I think recognizing when the charts start to evolve, that tells you something's happening. And
mhm,
as we go on, we'll realize what that story is and we'll make sense of it. But don't miss an opportunity just because you can't get your head around exactly what's going to create the value. And again, I think what's great about price action is it usually tells you what's working, and it's always right. The market's not wrong because the price is reflective of where things are headed. So
mhm,
when in doubt, follow the trends.
mhm. So to kind of just wrap a little bow on this, because
Mm.
I want to make sure we are a little bit clear for our listeners, because when you're showing those breadth indicators, it's almost like, uh-oh, watch out. Especially, frankly, I mean, you showed 2007 and 2020,
Yeah.
which were both some
And,
really
and to be clear,
horrible.
I think the header on that last one should be 2024 market top question mark, right? The
Okay.
question mark maybe should be there.
Yeah.
Well,
Yeah.
to be
So
determined, right?
right, to be determined, because again, in our first segment we were talking about how great everything looks and the trend is up, and
Yeah.
this kind of goes against that. So
Yeah.
what what is it that tells you that, oh, maybe this breadth thing was telling you something important that you need to watch? Or
Yeah.
is it
So
like, oh,
yeah.
this time it's more like January, where breadth didn't matter, it was the indexes kept going up?
Yeah. No, that's a really thoughtful question, Justin. I think that's the reality, right? With the 2007 top of the 2020 top, what happened after those breadth conditions changing is really the most important part, which is you then started to see the price trend finally move in line with what the expectations would be,
Mhm.
right? And then as I mentioned, a lot of these breadth divergences, when breadth starts to rotate lower, even as the indexes are going higher, that's a leading indicator. For me, I want to look for confirmation or what I would consider follow through, right? So after the peak, you start to see the price break down through those lines in the sand. We mentioned like with the S&P now, 5650 is a line in the hand,
Right.
maybe line in the sand, maybe the 50-day moving average or whatever it is. So as long as we hold that, and producer Mike, well done. That was awesome. Delivering with the question mark. Thank you for that, just to save myself here. Um, so I think still to be determined, but I think what this tells me is, okay, there's now an elevated risk of deterioration in price because these conditions look very similar to previous market tops. Now the proof is going to be in price reacting in a negative way. So starting to be unable to hold support, pulling back, and instead of making a higher low, you see further deterioration. The breadth conditions continue to deteriorate. We see less and less new 52-week highs, but you start to see more 52-week lows, which
Mhm.
those other two peaks, all of a sudden you set a bunch of like leading names to the downside that had already deteriorated quite a bit. We're not seeing any of that yet here in October. But I think that's what you look for now, is you look for confirmation that, yep, the breadth conditions really were a good identifier of negative conditions. The price is now reflecting what I was concerned about.
Yeah, very good. Let's go ahead and shift gears to some stocks.
Yeah.
Again, just to be clear, again, you're still looking at the trend. The trend is up, and there do still seem to be a lot of stocks that are setting up. Any particular areas of interest? And we're flying blind here because we didn't get a chance to talk about this ahead of time. So
There's no
yeah,
telling what I'll throw at you, Justin.
exactly. What do you got?
I mean, I'll start very simple with PLTR. I think Palantir is a great representative of the emerging strength that we've seen in technology. While some areas of technology have not been particularly strong, what I like about this chart is if you covered up the ticker and if you didn't know what was happening in the world around you and all of these concerning macro themes, this is a chart that's working and it's continuing to outperform. It's setting resistance levels and then breaking out. I mean, it's a classic kind of Charles Dow uptrend of higher highs and higher lows. And the fact that charts like this exist remind me of reading IBD back in the day as a print daily thing that I would buy at the newsstand. And no matter what was happening in the world, there were always charts that kind of looked like that ideal chart. Like they were just out there. You had to find them. And so I think charts like this deserve to be, again, considered innocent until proven guilty. I like the fact that the trend has been quite positive, upward sloping moving averages. The improvement in relative strength is what I appreciate the most. So charts like this, I'd build a portfolio around charts like this and feel very happy with that general approach.
Yeah. Now, I'll be honest. This is one that I've tried a few times, and it seemed like it was, oh, it moves on earnings and then it doesn't do anything.
Yeah,
It
yeah,
moves on earnings and then it doesn't do anything.
yeah,
This last time, it almost looked. I mean, it was just a really wild reaction. And
yeah.
then this is the time that it. So it kind of almost reminds me sometimes of how you can't treat stocks like people just because you get stood up on a date. Sometimes you gotta try and try again.
Yeah, and I always remind people that, I mean, literally, I mean, if you can't do this mentally, literally, like, get out of your chair and take a couple steps back from your monitor, and don't get so caught up in the short-term movements. Right? Stocks will be noisy, and day-to-day price action is noisy. So what I like to do is literally take a step back, think about what the trend. My 8-year-old son Henry, I always think, what would Henry say if I asked him, is
Mhm.
this chart going up or down? That's a Henry bull chart, right? Henry's going to say that's going up, and so that's, for me, that's what you want to remember. Don't get too drawn into the brief pullbacks, which will happen in any good market. Some of the biggest down days are going to happen during a nice uptrend, but they're just corrective moves within a larger upward trend. And I think PLTR is still showing those signs.
Well, now one other thing that does make PLTR a little bit harder is the
Mm,
moves day to day. So
yeah.
it's easy enough to say, David, oh, just step back and don't worry about the day to day. But some of these day to day are 5%, 7% moves in a day. Uh,
Yes.
how do you handle that if you're doing a 7% stop loss and that's just a day that ends in Y for Palantir?
Yeah.
How do you manage your risk?
No, I think that's a challenge, right? And I think that the reality is volatility certainly feels like it's increasing, not just with Palantir, but with a lot of things, right? I mean, the VIX is above 20 again. You're certainly seeing, that sort of slow and steady bull phase doesn't necessarily seem to be what we're experiencing now. This is more of a high volatility environment again. So the idea that a chart like Palantir isn't going to have significant drawdowns, I think you're kidding yourself if that's the
Mhm.
reality. There's always that balance, right, between having a good stop that makes sure you lock in, you minimize any sort of significant downdraft, but also keep plugged in enough and make sure that you remain engaged as the trend goes higher. For me, a percent stop is a good starting point. I like to move to things more based on like an average true range, a little more dynamic. And with something like
Mhm.
PLTR, you probably want to give yourself a little more room for those sorts of things. And with a lower volatility name, you tighten it up a little bit.
Yeah.
And then the other thing
Well,
is,
the good
remember,
news is
risk
using an
management is not
ATR.
just what's that?
I was just going to say the good news is using an ATR, it kind of does that for you, right? If you're like, oh, I'm going to
Yeah.
multiply the ATR by X,
Yeah.
it kind of does that for
The noisier the chart, the wider your stop is going to be because it's adjusting for that volatility. And so I think that's a good way to think of it. And also just remember, I mean, there are different ways to manage risk. I think stops are one of those. Thinking of position sizing and just how
you.
aggressive
Yeah.
you want to be with bets. Maybe keep your position size down so that you're not overexposed to the noise in a PLTR. I think those are levers investors can pull. They probably don't recognize how much power they have to ratchet the risk up or down if you're concerned
Mhm.
about volatility. I think there's a lot of options.
Yeah. Okay. So next chart. What else you got for us?
Yeah, Comcast is another one I'd highlight. CMCSA. And again, I'm looking at these mainly from a technical perspective, but I think particularly, if you look at what's happened most recently, Comcast back above the 200-day moving average. We just made a higher low here potentially in the last week. Maybe emerging from this kind of rounded bottoming type of pattern. It's not my ideal chart. My ideal chart is a nice strong uptrend, but with a lot of those charts, like a Palantir, in some ways maybe overextended because they've already had a really good run. Comcast strikes me as one that's a little earlier on in the uptrend, so maybe just emerging from a base. Again, given the uncertainty, given the choppiness in the world right now, I think keeping stops relatively tight, on average, isn't a bad idea. But I like that improvement that I'm seeing, at least in the last quarter. Comcast was an absolute nightmare of a chart through the middle of the year, and then that double bottom when you had a low in April, a low in June, and then we start to improve from there. I think is pretty encouraging. So overall, I think for now, worth the benefit of the doubt until proven otherwise.
Mm-hmm. And it's worth noting that Comcast has a dividend. So I mean, it's 3% dividend yield there. Now, again, one of the things that are you kind of going for a rotation in this case? Because yeah, the relative strength, of course, has been dismal. Anything below its 200-day moving average line recently is
Yeah,
probably taken a hit in that regard.
yeah.
So when you're kind of doing these bottoming bases, what kind of different strategies do you use as
No,
opposed to
really,
your
really good
traditional
question.
breakout?
Yeah, and I would say from a high level, I think part of this is an exercise in diversification. We think of
Mm,
diversification traditionally as asset allocation and being diversified in different ideas and stuff. For me, I think of technical diversification as if you own a bunch of stocks and their charts all look identical, you're probably playing a similar theme that is
right.
connecting those names, right? And so the danger with that is your entire portfolio is working, and then most likely your entire portfolio starts to struggle right around the same time. And that's not
Mhm.
guaranteed, but there's a danger. And so I would often look with a money manager and just think, okay, hold on, do we own too much? Are we doing an unintended bet that this theme is really starting to work? So I'm always thinking, all right, if I own a chart like Palantir, what other stocks are starting to improve, maybe a little earlier on in the rotation, maybe still having some to prove, but would probably be very differentiated return profile from the first one. And so I think that's one way to think of more bottom fishing candidates, is just thinking of how that actually diversifies your exposure to particular themes. I think with something like Comcast in particular, with a more established trend, you're basically betting on what has been happening to kind of continue. And so
Mhm.
you just want more of the same. You want the status quo. You want higher highs, higher lows. Even if they're noisy, you want them to sort of remain in a constructive way. With something like Comcast, it's sort of an emerging idea. So it's more about, can we clear resistance? Can we hold that resistance level? Like with the S&P, right? Hitting 5650 a couple times, breaking above it, and then does that now hold? And so seeing those early tests of a new uptrend and seeing if something like Comcast checks those boxes, and if not, then move on to other things. Justin Mamus, famous technical analyst and investor, famously said, if stock doesn't do what you expect it to, sell it. And what I think he was implying by that is, you have an idea of why you're betting on this trend, on what the chart would probably look like. If it does something dramatically different than you'd expect in a negative way, like, get out of the way and find another idea that is emerging again. I think that's one of the benefits you have as an equity investor. Just a lot of levers you could pull, a lot of ideas.
Mhm. And just one thing I'm gonna kind of mention
Mhm.
for in favor of Comcast is the telecom services. This is Comcast is in telecom services cable satellite. But if you look at the industry group ranks, I mean, for telecom services, there are a number that have been doing pretty well in their relative strength over 6 months. So you've got the foreign is in 57, cable satellite 71, integrated at 37, wireless at 28, and cable satellite equipment at number 11, consumer products at 21, fiber optics at 5, infrastructure number 1. So telecom has been kind of, not everything. You can see it's kind of widely dispersed, but there's a number of groups in that sector that have been improving quite dramatically lately.
For sure. And arguably the old telecoms within communication source like AT&T comes to mind, right, as a great example of strong price action, great dividend. I mean, one of the better dividends that you see in a stable company. And what's good about a chart like AT&T, if you're concerned about rates going back lower, if you're concerned about lower rates, meaning bonds are not a particularly good place to be anymore, something like this with a decent dividend is a good way to play it. Lower volatility, good price action with good income means it's probably a good defensive play if you do see any deterioration. So thinking about some of these areas of the market that have been strong, but also have kind of those qualities of defensive names can be a good way to sort of mitigate downside risk in the markets.
Yeah, and it's worth mentioning the yield on AT&T is 5%, over 5%, and I mean, this is a strong looking chart, and that's not even considering the yield in there. So if you did
That's
a
right.
total
That's just the
return,
price. Yeah.
yeah, that's just the price. So
Yep.
one more chart for you. We can get through quickly, or
VF Corp, VFC.
VFC.
Yeah, VFC probably looks like what I hope Comcast would look like. It's sort of, if you think about Comcast, right, it's sort of like that basing pattern, that bottoming pattern, but still with a lot to prove. I would argue like a VFC is one that has shown what can happen coming out of these bases. And I don't think it's necessarily too late to be participating in a chart like this. But I would say what this is a great example of is what bottom fishing, how that can benefit. Even if the market conditions are quite strong, looking for stocks that have been in a downtrend and then what I call is a change of character, right? If you look at the right kind of quarter of that chart versus the left 3/4, something's obviously very different. And I think, every technical reason why it was a horrible place to be in April and May from a technical perspective has now changed because we've, in a confirmed downtrend below downward sloping moving averages to a confirmed uptrend above upward sloping moving averages, right? We're making new swing highs. We're making progress on the way up. And the other thing I would say is the price momentum is improving, right? So overall, you're seeing stronger up days, and so for me, I think that's a great sort of example of what, when you're looking at a chart like Comcast, if it feels too early, this is what you want it to develop into. And I'm impressed by names like this that had been chronic underperformers, really starting to maybe emerge in a new leadership role.
Do fundamentals come into play at all? Because they're not great here.
They're horrible. So no, arguably no. So this one is not a fundamental play. This is purely a technical. The charts are telling me to think of it differently. Thinking holistically, I think that's the challenge for a name like this. Is you're buying into a name where the numbers are not particularly strong here. So what I was always taught is that the stocks eventually trade to their fundamentals. So you really, if you're buying it, you're betting on that picture improving down the road over time. For now, it's telling you something is different and something's improving, and that's why I think it's interesting here.
Yeah. Well, David, it's always a pleasure to have you on, and it's always a great conversation. So on Twitter, folks can follow you there, or I should say X. That's at DKellerCMT, right? You had to get those 3 letters in there, right?
That's right.
Yeah, and then your website again, Sierra Alpha is your new venture that you're doing. You've got the market misbehavior website, so that's just marketmisbehavior.com, right?
Yeah.
And anywhere else that people should be looking? I mean, of course, YouTube. You've got a lot of content on YouTube.
Yeah, I've got an active YouTube channel, getting more and more active. So hopefully, at some point, Justin, I can get you to call into my podcast, and we'll return the favor if you're up for it. That would be a blast.
Yeah. As long as I don't have to go up to Seattle in the rain.
Well, I won't subject you to Seattle until next spring. Okay, this is the
perfect.
Where you don't.
I love Seattle. I love Seattle. I love
Seattle in the middle of the summer months are where you're going to enjoy Seattle a lot more than the rainy period we're embarking on. But no, yeah, marketmisbehavior.com is my website. My YouTube channel has the same name, And I'll look forward to engaging with anyone and everyone on those places.
Yeah. Well, thanks a lot for showing up today. And I really appreciate your insights. Again, the technical action, no one better to kind of walk us through it. So thanks a lot, David.
Appreciate it, Justin. And thanks, Mike, for your help getting this going.
Very good. Well, that's going to wrap it up for us this week. Please join us next week. We're going to have Mark Minervini coming by. He is, again, he's a market wizard. He's been featured in the Market Wizard books, two-time U.S. investing champion, a great friend of the show. So it'll be great to welcome him back. So we should be chatting with him next week. Thank you so much for joining us this week. Don't forget, we're going live every Wednesday at 2 p.m. Pacific. And like and subscribe to our stuff, because that helps us kind of stay engaged with you. We really appreciate you showing up today. And that will wrap it up for us. We'll see you next week. Bye-bye now.